Friends, welcome once again. This is your host, none other than Mr. Spotter Fred. Now, friends, this is session 2 in respect to our dependent branches. We are talking about financial reporting, and mainly we are looking at dependent branches. In our first session, you notice that we looked at what a dependent branch is. We looked at the type of accounts or books of accounts that are likely to be maintained for a dependent branch. That's what we looked at in our session 1. This second session, friends, we want to look at an illustration that, apart from the format of the overview of the overview of the branch inventory account, branch markup account, the goods sent to branch account, and the branch debtors and cash, and the branch memorandum trading profit and loss account. We looked at those formats. Now we want to use them to solve a question. We want to look at an illustration. Look at an illustration. The illustration we want to look at is an illustration that was set some time back in our past paper. It's a past paper question which was set in 2001, and that's what we want to look at to illustrate what we are learning now. One is a question in December 2001. That was a question 1. A question 2. Now, this illustration, here it goes. Victoria Gowns is a fashionable ladies' wear a chain of clothing stores started in Kakamega but now present in all major towns in Kenya and in Kampala, Uganda, and in Dar es Salaam, Tanzania. The accounts of all the branches are maintained in the books of the head office, now situated in Nairobi. The figures below that refer for goods to goods are stated as selling prices. The following figures relate to transactions carried out by Mombasa branch by Mombasa branch in the year ended that 1st May 2001. There is opening stock at commencement of the year, goods received from the head office. We have the goods received from Voi branch. We have the goods sent to Taita branch. We have the goods returned to Mombasa branch by credit customer. We have the goods returned to Voi branch by Mombasa credit customer. We have the head office. All these goods had been marked up by 15%. Goods returned by Mombasa branch to the head office. We have the cash sales. We have the cash stolen branch from Mombasa branch on 12 December 2000. We have the goods stolen from Mombasa branch on 12 December 2000. We have the credit sales of 61,686. We have the Mombasa branch admin expenses. We have the Mombasa branch distribution costs. Additional information: 1. The Mombasa branch is managed by a particularly competent group of women. Other than the theft stated above, there were no shortages or surpluses of goods or cash during the year. 2. Demand for certain casual wear has been high during the year to prevent stockouts from occurring. These lines are normally marked up in price using a formula linked to the number of items sold in the preceding week. Included in the opening stock were goods with a normal selling price of 800,000, but which had been marked up by a further 10% of this price. The normal selling price of the goods is head office cost plus 60% of cost. All these marked up goods were sold in the year. Goods with a normal selling price of 1,120,000 have been marked up by an additional 50%. 3/4 of these goods have been sold by 31st May 2001. 3. In the income statement produced for management, cash stolen and goods stolen are shown as separate line items. Now, required, prepare the Mombasa branch stock account and the Mombasa branch markup account in the books of the head office, and the memorandum trading and profit and loss account for the Mombasa branch for the year ended that 1st May 2001. That was given or awarded 17 marks. Now, from the required point of view, we are to prepare a Mombasa branch stock account, then a branch markup account, then we have been told to prepare a memorandum trading profit and loss account. So there's some other items that have been left out. Like the goods sent to the branch account is not being required, but we're going to have it anyway for visual purposes. Fine. We go back to our additional information given there. Maybe we start from the beginning. At the beginning up there, we have been told that is a fashionable ladies' wear that has many branches, not only in Kenya, Tanzania and Uganda as well. We have been given some items for Mombasa branch, which are at selling price. We have been given the open stock, the selling price, goods received from the head office, from Voi branch, and goods sent to Taita branch. They are all at selling price. There's something interesting there. There are some goods which were returned to Voi branch by Mombasa credit customer, approved by the head office. All these goods have been marked up by 15%. There is a markup in prices. That's okay. We are going to deal with that one. That's okay. Then we have goods returned by Mombasa branch to the head office. We have cash sales. We have cash stolen. We have the goods stolen. We have the credit sales. We have the admin and distribution costs. That's okay. Additional information that the Mombasa branch is managed by a particularly competent group of women. Other than the theft stated above, there were no shortages or surpluses of goods or cash during the year. You see, these are thefts, and they're saying that is particularly competent group of women, and they have told us that some thefts, that is definitely some items which were stolen, goods stolen. And, you know, in that case, we never expected this. So this means that those are abnormal losses. The goods stolen up there, they're actually abnormal losses. And you know what we are going to do with that. Number two, demand for certain cashware has been high during the year. To prevent stockouts from occurring, these lines are normally marked up by up in price using a formula linked to the number of items sold in the preceding week. Included in the opening stock were goods with a normal selling price of 800,000, but which had been marked up by a further 10% of this price. We have been told that there is an opening stock, yes. The opening stock which we have there is 5280. That 5280 includes some goods which had been marked up by a 10% in the previous year that they had not been sold. They're included in the opening stock. But we have been told that these goods, we have been told the normal selling price of these head office cost plus 60% of cost, all these marked up goods were sold in the year. We have been told that in the previous year, they had increased the selling price by 10%. Some of the goods had not been sold by the closing period of the previous year. They were part and parcel of the opening stock in the current year. But we have been told they were sold. Now, one thing we need to do, we need to determine the total profit loading. What is the total profit loading at the beginning of the year? What is the unrealized profits? To determine the unrealized profits, we are not only going to take the margin on the 5280. No, it will not be correct, because that 5280, it has the normal profit and it has the anomalized profit. So we need to get the total profit accordingly. We have been told that the normal selling price of goods at the head office cost plus 60% of cost. We have been told there that if you talk of the pricing, they are saying that the normal selling price is equal to costs plus markup of 60%. In that case, the costs, if you have been given a markup, then definitely our cost in this case is 100%. And our selling price in that case, normal selling price, will be 100% plus the 60%. So that comes to 160%. That's our normal selling price. Alternatively, or I could say our markup is 60%, which is 60 over 100. And you know, this is definitely a gross profit over costs. What will be our margin? our margin is a gross profit over costs plus gross profit, so that to make it a gross profit over sales. And in that case, we are talking about 60 over 100 plus 60. So in that case, our margin is 60 over 160. If you cancel this or you make this, this comes to 3, and this comes to, this is 3, this is 8. So we have it as 3 over 8. Friends, if our margin is 3 over 8, then our cost is 1 minus 3 over 8, and that is 5 over 8. So we have our margin there. We have our margin, and if you want to get the profit loading, you take the margin, you multiply the selling price. If you want to get the cost, you take the 5 over 8, you multiply the selling price. Alternatively, you can use this option and get those items. Then they have told us that there are some goods which were included and they had been increased initially by 10%. That's okay. But further, all these marked up goods, we have been told they were sold during the year, the one for the previous year, while goods with a normal selling price of 20,000 have been marked up by an addition of 15%. 3/4 of these goods have been sold by 31st May 2001. Had been sold. Now, there are two scenarios here. The first scenario relates to the previous year. We had increased our goods by 10% in the previous year. But the second scenario is where in the current year, we had increased our goods by 15%. And part of those goods that were not sold in the current, that were increased in the current year are not been sold in the current year. No, they are behaving the same way, but with different figures and different percentages. They were all increased. In the previous year, we increased some items. Even the current year, we increased some prices. In the previous year, we increased by 10%. In the current year, we increased by 15%. In the previous year, we increased the selling goods of a selling price of 800,000. In the current year, we have increased goods of a selling price of 1120. In the previous year, the goods that are not been sold 800,000, and in the current year, the goods that are not been sold is we have been sold 3/4 had been sold, so 1/4 has not been sold. They are behaving the same way, but with different figures in that case. So the same concept, but different figures. So there's a concept that will affect the opening stock. There's a concept that will affect the closing stock. Now, in that case, we are be given that information in order to determine the exact total and realized profits at the beginning of the period and at the end of the period. We can easily get the one at the beginning of the period now, but the unrealized profits at the end of the period at the balance sheet date will be determined after we have computed the closing stock from our branch inventory account. So let me also look at another working. So this was one working one. We look at working two. Working two, we want to determine the unrealized profits. The unrealized profits. And the stock at costs at the beginning, at the start of the year. So we know that in this case we have the selling price. We are going to talk about the profit loading. We call it our unrealized profits, and we talk about the costs. In that case, we realize that, let's say these are our details. There is some goods with a normal selling price. Normal selling price. There is some goods with the normalized. And there is the total. Friends, we have been told that the total selling price, which is in thousands, the total selling price is 52.80. Out of that 52.80, there are some goods which had been normalized. That is included here. So we know that they had been normalized by 10%. So 10% of 800,000. This 800,000 is included in the 52.80. But 10% of that 800,000 is anomaly that had been adjusted in the previous period. And that 10% of 800,000 is also included in the 52.80. So you come and say 10% of 800, that is 80. Now, what will be our normal selling price? Goods with the normal selling price. So 52.80 minus 80. How much will that be? That, friends, comes to 5,200. Remember, we didn't have the 5,200, but we were able to get the 80, because you know that including the 52.80, there are some goods which had been anomalized by an additional 10%. So that's what we have as 80. 80 is included in the 52.80. So goods with a normal selling price is 5,200. Then we come and say the profit loading of that. We take our calculator. Our profit loading, we have a margin of 3/8. The cost is 5/8. So I'll come and say, like, if you are talking about the profit loading, if you are talking about the profit loading, friends, you either take the margin, you multiply the selling price. Like in this case, the normal selling price, we are talking about 3/8 by 5,200. I come and say 3/8 by 5,200. We are getting 1950. Alternatively, you could come and say that our selling price is 160%. Can say, or I can say selling price at 160% is equals to 5,200. Then how about the profit? The profit loading, which will be the 60%. How much is that? Believe you me, friends, it will give you the same answer. We can confirm that. It will give you the same answer, and that is actually what we have as 1950. So any can do, and you still get the same answer. So we have these as 1950. What will be the costs? Now, the costs. The cost, we take 5/8. 5/8, you multiply the 5,200. What are you getting? So we take 5/8, we multiply the 5,200, and we're getting 3,250. 3,250. So alternatively, apart from that, you can simply say if the selling price is at 160%, that is 5,200. How about our costs? The cost is at 100%. What will it be? Friends, it will have to come to the same answer. And does it? We come to the normalized. The 80, 10% of 800 is 80. So the whole of this 80 is anomaly. The whole of it is a profit. There is no cost item. There is no costs attached to this 80. So the whole of it is a profit loading. So there is nothing for that case. So I take 1950 and I add it to 80. I'm getting 2030. That's 2030. This one remains 3,250. So friends, we already have in our branch markup account, we have the 2020 as our realized profit. We have our opening cost, opening stock at 3,250, and that is going to help us in our subsequent, when we're preparing the memorandum trading profit and loss account. Because I need those figures later, I have to write them somewhere. So we have the profit loading. The profit loading is 2030. I have the opening stock at cost. Opening stock at cost, 3,250. We need those figures very importantly. Okay, fine. Now, we move on and look at the next. What else? There's something interesting. You know, during the year, some goods were increased the selling price. We can come and say, maybe working number 2, increase in selling price of goods during the year. During the year, some goods were increased their selling price, and the normal selling price of these goods, normal selling price is 11.20. So they were increased by 15% increase. That's a markup is 15% of 11.20. 15% of 11.20, which we have as 15% of 11.20, 168. Now friends, this one, we are going to debit our branch inventory account. We credit a branch markup account with 168,000. That's okay. But we have been told that a half of this, they are normalized. Normalized. The normalized. The normalized, not yet sold, will be the 15% of 11.20 by a quarter, because they have sold 3 quarters. So by a quarter, and that is 42. That is 42. Friends, this 42,000 is going to behave like 80,000. The 42,000 will behave like 80,000, while the 11.20 will behave like 800. That's when we'll be dealing with the closing stock. The 11.20 will behave like 800,000. I think 11.20, a quarter, 280. Out of 11.20, there is 280 that has not been sold. So the 280 will actually behave like 800,000 because it had not been sold at the balance sheet date. I can even say that. Yeah. Normalized goods at selling price not sold is simply 11.20 by a quarter, and that is the 280,000. That's important. It's good to also have that information. But at the same time, friends, there are some goods which had been increased the selling price and they were returned. They were returned by the branch customer. This branch customer returned it to Voi branch. Remember, we are dealing with the Mombasa branch. So if you return to Mombasa branch, to Voi branch, then definitely it's like you return these goods to the head office directly. We need to determine the total profit loading. We need to determine the total profit loading and original costs on goods returned by Mombasa customer to Voi. We need the total profit loading and original costs on the goods returned by Mombasa customer to Voi branch. Why do we need these, friends? Remember, when goods are being returned by a customer, we are going to debit our branch markup account with the total profit loading. Apart from the normal profit, there is also the additional profit, the total profit loading, and we debit the goods sent to the branch at cost, and then we credit our branch debtors account with the total selling price. So that's why we need to get the total, the total profit loading. Now we have been told that goods returned to Voi branch by Mombasa credit customer approved by the head office, all these goods are being marked up by 15%. The total selling price is 322. So we are saying the new selling price, which is at 100% plus 15%. is equal to 322,000. That's the new selling price. Now let me say the old selling price is something to do with X. Let me call it X. Or we just say is 100%. Say is 100%. The old selling price is 100%. Let's say that. So what are we going to do? Come and say then 115% is equal to 322,000. What will be this? What will be the old selling price? What will be the old selling price? So what is the 100%? What is the 100%? The old selling price. So the old selling price, definitely, we are going to say 322. We have it as that is 280. So we have it as 280. 280,000. That's okay. So 280,000 is the old selling price. Now what will be our additional selling price? Additional profit. It means that the increase in selling price is simply 15% of the 280,000. That comes to how much? So I take 15 by 280 and I'm getting 42,000. Alternatively, I could simply say 322 minus 280. Then what will be our normal selling price? Sorry, normal profit loading. Normal profit loading, we take the margin, and the margin is 3/8 by 280. So 3/8 by 280, you're getting 105. So what will be our total profit loading? Our total profit loading plus the 42, we have 147. That's the total profit loading. Now what is our original costs? Our original costs, we come here and say friends, our original costs will be either we take 5/8 by the 280,000, that's 175,000. Alternatively, or I just simply take 322 minus the 147 to give you the same. That's it. So you can take the new selling price, you subtract the total profit loading, you get the original costs. Now what are we going to do with this? Now just the double entry, the entry. What entry are we going to do in this? We are going to debit our Mombasa branch markup account with the 147,000. We also debit the goods sent to Mombasa branch markup account with the cost. The cost is 175,000. Then we credit our Mombasa branch customer branch debtors account with the total 322,000. That's just a signal of what we are or what we're expecting to do. So that's not a problem at all, and we are going to deal with it, or we are going to use it. Now, from here, friends, we are good to go. Now we can be able to prepare our branch markup account. We prepare our branch stock account. We also prepare even the goods sent to branch and those other the memorandum trading profit. So let's come and do the necessary.